This chart is a comparison of the US long-term interest rates to the price-earnings ratio of the S&P Composite Index. What is interesting here is the correlation of long-term interest rates being at extreme lows and stocks being extremely overpriced. The PE ratio line shows that in relation to earnings, the stock prices were too high in 1929, 1966, and incredibly high in 2000. As I mentioned previously, the PE ratio is a way of valuing earnings versus the cost of a business. So incredibly high PE ratios means that the company, industry, or indeed market is extremely overpriced. So looking historically at this chart, we can clearly see that these extreme high points were never sustained. They essentially showed us the top of a boom leading to a dramatic bust and the equilibrium of the market needing to be refound at a lower level. So what can we gather from this? If we see the PE ratio of the S&P Composite Index, for example, rise above 25, then stocks may be overpriced. Be very wary of an overpriced market. The PE ratio shows us how stocks are priced relative to their actual earnings. So a PE of 20 would mean, based on the capital invested, it would take those companies 20 years to pay back the investor. Or viewed another way, it means that an investor is willing to pay 20 times the earnings of the company for a stake in that business. Here, I have plotted an average of the PE ratio across this period. And you can see that average has slowly grown from the 1880s to encompass between 12 and 20%. So since 2000, the market's corrected itself and corrected itself again back to what we could term a more reasonable level. So the question is, how much growth can we see in the market from where we are today? Now that might be quite limited. We'd need to see strong earnings to justify further growth in the markets and the stock prices. So to recap on this section, it's very important that you keep your eye on the extreme long-term view of the markets and the valuations of the markets. This information is available, some of it on Wikipedia, and you should be able to look at this on a regular basis, let's say on a quarterly or yearly basis, just to make sure that the market isn't overheating. And if you see the price earnings ratios increasing above, let's say, the 25% mark, where most of the busts have occurred in the last 100 years, then you need to be very, very careful about what you're investing your money in, and be very quick if you see a huge downturn to pull your money out until the market has made a significant correction.